2/10. And we will also start the chapter 2 handout. It looks like a lot, but it's actually not. We'll probably be out early tonight. So again, so this will be emailed to you usually like half hour after the end of class. Now, when you submit it, you're going to submit it into Blackboard. And you'll notice that the file isn't available. It's only going to be emailed. And the reason is because there's different forms of it. So when you complete the exam, then you go into Blackboard and submit it. Question on that?
All good from my end.
Okay. So yeah, in the chapter 2 stuff we're going to cover, we're not going to cover the entire handout. We're only going to cover the first few pages of it because it gets into a little bit of the stuff going into chapter 3. But it's somewhat similar to what we've been doing, but a little bit of a twist to it. Okay, so let's see here. This is what you should have gotten for, I believe anyways, check, unless I did it wrong, which is possible. This is the solution to problem 11. And I think when I did this last time, I was telling you guys there, the interesting thing about the equity method is that the investment account is in every single journal entry. So every single journal entry has the investment account. Any question on that? Okay. Well, let's go to.
Professor, can you pull that back up for a moment?
Certainly can. Yeah, and feel free, guys, to take screenshots of this.
The first one at the top is supposed to be 300,000 for the credit.
No, that's a copy and paste there. Thank you.
Okay. Okay, wait a minute.
That was for my benefit that you. Yes, thank you.
All right.
Do the rest of these match? Yeah, that should be. Yeah. I knew that at some point, but. All right. Okay. So the practice exam, this one's a little bit more involved. This is your exam will be similar to this you have here, and it's a little bit more involved than what we've been doing, but a lot of it's the same. And so let's see here. Well, I tell you what, let's do the easy entries first, and then we'll go on with the more difficult ones. So the easy entry, the first one, they bought it for 50,000. If I can bold that. Hey, I can. All right, so 50,000. So what would the journal entry for that be? Well, you know at least half of it.
Investment equity.
Yep.
Would be debited the 50,000, and then cash credited the 50,000.
Yep. And again, this is going to be in every the investment equity account is going to be in every one of these. So. This is an asset going down, where I have less cash now, 50,000. Did I put the thing? I didn't put that thing in there, should have. So every single account's gonna have this in it somewhere. Okay, let's go to, they give us dates on these. Well, let me look at it. It just has this for the income and dividends. I think I usually put dividends first. The reason I put dividends first usually is they're paid during the year, and usually, and you don't know the net income till the end of the year. You know, it's impossible to get this in 2023. You gotta wait till 2024 basically to know what the income is. So dividends are usually paid first. So that's usually how I have it here. Okay, so dividends paid. How much in dividends are they going to get?
2,400.
Yep. I'll do it right here, actually. So they're going to get dividends of 2,400. Might as well put it. I'll copy it down here too. All right. So what's the journal entry going to be?
Debit cash.
Yep.
Credit equity investment.
Good. Cash is going up. And we always have to have this equity investment in there. So and it is basically our equity investment is going down by 2,400. And again, it's because we own so much of it that we're basically paying ourselves. We're taking it out of one investment, putting it in the other. Uh-oh. Can you guys still hear me and see me?
Yeah, I
Yes.
can.
Oh, okay.
Yeah, me too.
I just got a message. I keep getting these weird. I get a message that my connection's unstable, which is kind of a rude thing to say to somebody. But all right, so yeah, so here's the investment account, and that's gonna be everyone. Okay, now let's go to the income, and how much income do we get?
It would be 25,000 times 30%, right?
Yep. The 7,500.
Yes.
Okay, so this would be our share of the income. Oops, an equal sign in there. So this will be our share of the income. Yeah, what would the journal entry be for that?
Debit investment equity this time. And then credit investment income.
Yep. Again, we have our equity account in there, or investment account. All right. Now, so let's take a look here. Didn't add those up. So the fair value of the assets. Down below time. $185, I think. $185,000. All right, and these down here, I think are the same. Okay, so they bought a 30% interest in it. And Joan is able to exert significant influence over Erickson. Okay. So now we are going to get the excess. Assets. 0, 0. We don't need to put those in there. All right, so this one, the excess would be 20,000. And for this one, the excess would be 10. Okay. Now, our share of those would be how much?
6,000. Wait, 6,000 for the equipment.
Yeah, yep.
And 3,000. Okay.
And this one would be what, 20?
3,000.
Yep.
Thanks.
Okay. So let's come down here. So we have to do journal entry. So this would be for the excess equipment. Be 6,000. Yeah. So it's 6,000. And we have to depreciate that over
10 years.
Oh yeah, yep, 10 years. Oh, my thing got goofed up there. Yep, so 10 years. $600. And then we also have the excess for the patents. It's 3,000. I'm trying to make these the same. Nope, I'm not going to try to make these the same. All right, 3,000. All right. 6 years. Is that 500?
Yes.
Okay. So we have to take off 1,100 off of the income. So how are we going to do that?
Debit investment income.
Yep. So the total there is 11. Let's see if I can put this way. 1,100. And on the other side, the account we love. We use it every single time. Investment. Equity. That's an asset going down. We're depreciating it by $1,100. And we'll make that same, the same entry. We'll make the same entry for the next 6 years, and then this one will keep going on for the next 10 years. And then once it's all depreciated, then we'll not have to worry about it, but. Okay, so you get something similar to that. Any question on that? All right. Well, so the next thing we're going to do is go on to chapter 2. Okay, well, just to kind of wrap up, wait a minute, let me show you one more thing here. So the chapter 1 handout, most of you already got this in. The chapter 1 practice exam we just did, you turn that in. So I'll send the test out for chapter 1 later on tonight. So we're going to start in on chapter 2, and the stuff we're going to look at is somewhat similar to what we've been doing. All right, chapter 2 handout. They're kind of looking at what I have in here. What I'm gonna. Okay, so here is. Here's how the chapter 1 and chapter 2 the types of accounting are kind of organized. The equity method. Equity method is for 20 to 50% ownership. Consolidations or consolidated financial statements is when there are 50% plus ownership. Now, basically what they do for the consolidations, there's a couple different types of consolidations, but the one we'll be looking at more in the future, you'll actually be doing the equity method with it. So consolidations, even though it's we're going to combine our financial statements, what they generally do is they use the equity method throughout the year, and then they switch over at the end of the year to do the consolidation. So even though we learn the equity method and we're not going to give up on it, it's actually when you have 100% of the company, you use the same method. Basically, it's the equity method, except that now you're going to also show the financial statements that go with it. Chapter 2, it's all configured for 100% ownership. So now we're moving away from the 20 to 50% ownership, And we're gonna go all the way up to the 100% ownership, just because it's easier. It's easier to do 100% ownership than 70% ownership, which we'll get into later. But so we're gonna assume now that we buy the entire company. And when you buy the entire company, there are a couple of ways of doing it. The one is that you buy the other company and dissolve it. So in other words, you just take all their assets, all their liabilities and all that stuff, and you put them on your books in one journal entry, and that company no longer exists. And you don't have to worry about consolidated financial statements because everything they have, now you have on your books. So the one is that they dissolve the company. There's also ones that they leave the company, that they don't dissolve the company. The company keeps going on business as usual. And for those, it's a little bit more involved. We'll talk about that next class with more. But yeah, so the one type of buying 100%, you dissolve the company. We're not going to use your name or anything else. We're going to dissolve the company and just fold it into ours. And the other one is when you let them go on as usual. They'll make their own financial statements. They'll have their own financial statements that are audited and all that kind of stuff. It just, they go on as they always have. So that's what we're going to be looking at. So the first one we're going to do is when it's dissolved. Okay, so this is the one I'm going to start out with. It's probably the most intuitive one. And the second one here is having acquired is not dissolved. So the first one, we simply purchase the assets and the liabilities. Take them, put them on our books. You'll see this called a statutory merger. Statutory just means that by statute, it'll be dissolved. It's a legal term because there's still going to be liabilities and all that kind of stuff that go along with it. And this one, everything just goes on like normal, and we do consolidated financial statements. We take the two financial statements and we smush them together. Okay. Amount paid, the consideration transferred. Fair value of the assets and liabilities. We always use fair value. We already been doing that. Okay, so if the amount paid equals a fair value, no special accounting rules. If it
Can I ask you something?
Sure.
When a company is acquired, who decides what's the fair value of the assets? Like, is there like a certain count, like auditors count, or whoever is buying, or both sides are present and they count and estimate the fair values?
That's a very interesting question. Yes, they usually have people that will come in, will specialize in it, that will come up with fair values, and they have to justify those fair values.
Right. Okay.
But usually, and I say usually that this shouldn't have it, the auditors should not be the ones doing it, because the auditors are going to have to be objective.
Mhm.
So a lot of times they'll have, like, if they have a CPA firm A, let's say, audits their books, they're not going to be the ones doing the evaluation, because they're going to come back and audit it, and they can't audit their own work.
Right.
So what they usually have is they bring somebody else in. It could be a specialist, could be another CPA firm, could be CPA firm B or whatever. And yeah, so they do. They'll come in, and there has to be a justification of it. And as an auditor, you look at the method of it. Was the method correct? And then also were the calculations correct?
Okay. Understand. Thank you.
Yeah. But no, it's a really big area, and it was an area that was abused before the Sarbanes-Oxley Act came out.
Mhm.
You'd have the same CPA firm do the valuations and then come in and audit their, their valuations. They audited themselves. I mean, which is not the way an audit usually works.
Okay. Thank you for clarification.
Yeah, it's a good question. And it's a very big area. Okay, so if it exceeds the fair value, goodwill, I see, if it exceeds the fair value, then goodwill will appear. So sometimes they'll have goodwill based on the company is being run better than usual, more profitable than usual, like we talked about that. And this third one is the strangest one. I say, well, it's strange now to me, but or when it first came out. You'll have a gain on the purchase if the amount you paid is less than the identified assets. Now, this is really strange. And I believe this is the only thing in accounting, in the US accounting anyways, where you can actually book a gain on a purchase. Usually if you have a gain, it's on a sale. You buy something and you sell it. When you sell it, you'll have a gain. That's when you recognize the gain, whenever you sell it. This, and I'll explain why when we get to it. If you have a gain, you recognize the gain when you purchase it. So if you purchase something for less than the fair value of the assets, you actually mark a gain up on your books, even though the transaction isn't what they call, completed. Because the assets still exist and all, you haven't resold those for a gain or anything like that. And that was like a huge no-no for years. You never ever book a gain on a purchase, but in this method you do. The new rules are you do, and part of, well, I'll explain it when we get to it. It's kind of, it'll make more sense when we get to it. Okay. Types of combination costs, direct costs. These are those things that are directly related to it, and the indirect costs. And for the most part, those are expensed. Let's see. Get this back. Okay, securities and insurance issuance and registration costs are reduction in, we're not going to get too much into this. Reduction in the debit and the additional paid in capital. Don't worry too much about it. Okay, so this is a very important page. We're not going to go over it till next class. You can look at it. I don't know, looking at it. But... All right. So we're going to come down here. So this is what we do when a company is dissolved. Okay, so Bengals Corporation bought 100% of Canary Corporation stock on January 1st, 2022 for 150,000. Bengal dissolved Canary after the acquisition. Oh, yeah. Okay, so the net assets. Come over here, we use the fair value column. The net assets were what's that, 120,000?
It's 130.
It's 130.
Yes.
Yeah, this is wrong. Wait, something's wrong here.
250 minus 120 is 130. While 270 minus 150 is 120.
Yeah. Okay, so this is 130. So 130 for the book values or the carry values. And oops. 270 minus 120 is I had the wrong
150.
Yeah, I had 150. 150 was actually what it should have been down here. Who made this stupid handout? All right, so this is so this is 150. So this is how we got this is buying it at the fair value, right? All right. So, not sure why I left this big space here, but. So what we're going to do is we're going to take each of these assets. Now we're going to take current assets all together. Yeah, in real life, they'd probably break them out into cash, accounts receivable, inventory and all that. But we're going to take them all just to speed up the journal entry. We're going to take them all at once. So current assets, we're going to put them at the fair values. Land, same thing. Oh, wait. Assets going up. Building is going up. So you kind of see it's almost like we're just buying a bunch of assets, really, is what it's doing. We're also going to take their liabilities, but and equipment. And now we're going to move down to the liabilities. Payable. Oops. The liability going up. So we've assumed their liabilities. We're going to take on their liabilities. We bought out the place. 35,000. And we are legal, even though we bought out the place, we are legally obligated to their liabilities. So you can tell right now if these two sides don't equal. What other account do we need? So far, we have 270 over here.
A goodwill account?
Not on this one, I will. Yes. Yeah, Irma is right. Cash. So our cash is going to go. Our cash is going to go down by. $150,000. And now both these sides will equal 270. So this is our cash that we're paying to them for this for the business. And once we do this, we're dissolving that old company. All of their stuff is going to be on our books from now on. And we're going to depreciate it just like we normally do and all the other stuff. It just becomes part of our stuff. Any question on that thing? Okay, let's go to number 4. Is now closer than I thought. Okay, there we go. And everything is exactly the same. I did that for a reason. Just to speed things up. Matter of fact, we can just copy most of this. Oh, I know what I wanted to mention up here, though. Notice that we do put the equipment on at the fair value. You know, everything goes on at the fair value. These are all fair value amounts. I don't know where to put it. So we don't do anything. We don't do anything with the net assets for the carry value or the book value. Yeah, sometimes it's called the same thing. Okay, so coming down here, everything is exactly the same, except that we paid 174,000 for it. So notice that this is different. So what would we call that excess money that we paid for this?
Is it goodwill?
Yep, it is. Okay, so we will have goodwill. Will be 174,000. Minus the fair value. Equals 24,000.
Yep.
Good. Okay. So everything is going to be pretty much the same with the exception of two entries. In fact, I'm going to copy this. I'm going to teach you guys how to be lazy like me. Okay. Very important skill to know. Be lazy. All right. So I'm going to copy this. So this is current assets. Okay. And we have to put one more asset on there. What is it?
The other one will be goodwill.
Yep, good. So goodwill, it's an asset. Going up. Let me fold all of this. For 24,000. So it's going to go on the books just like any other asset. $24,000. Okay, continuing in my teaching how to be lazy theme. Copy these down. Now the cash account is going to be what?
174.
4.
Yep. So this one will be different too. And that goodwill just sits there like a lump. It doesn't do anything. You don't amortize it or depreciate it or anything. It just sits there. And the only time you take it off is if it's become what you call impaired. And goodwill is usually when you're running the place well. So let's say you have a restaurant and the restaurant's being run very well, maybe it's, 30% more profitable than a normal restaurant that size. So they have goodwill. Well, suppose they have like a really bad food poisoning outbreak and no one goes there anymore. It's possible that that goodwill would be wiped out. And that's the only time you would do anything with this account. But if nothing crazy happens, you just leave it on the books forever. Okay. Now, number 5. The one that is a little strange. It's a little strange, but it's a lot easier actually than it used to be. Okay, everything else is the same except they purchased it for 132,000. Okay, so we definitely don't have goodwill here. They used to call this bad will. But they
Bless
don't,
you.
bless you. Yeah, they don't do that anymore.
Thank you.
In this
So
case,
we,
go ahead.
yes, sorry. So yeah, we paid less, which means we're gonna have some gain on the purchase, right?
Exactly. Wait, I might need more room for this. Hold on. Okay, so gain on purchase will be, we got 150,000 worth of stuff, but we only paid 132 for it. What is it, 18,000? I think. So we have 18,000 of the gain. Okay, so we are going to put that into our journal entries. Go all the way up to the first one here and copy the entire thing. So everything goes on here. I'll give you guys a second. Here's up to that. Okay, so we put everything on the books at the fair value. All the assets go on at fair value, all the liability go on at fair value, just like we've always been doing. The cash is actually at fair value too, if you think about it. Cash 132,000. And we still need to put what on the books?
The gain.
The gain, and it's going to go on as a credit. And this is the strange one. In the past, this was a huge no-no. But now we put a gain on the books on a purchase. Cool, and now we've changed this. I'll tell you why they did this. In the past, you would take that gain and you would reduce the non-current accounts by 18,000, and you'd have to appropriate and all that kind of stuff. Now, there is a problem with doing that. The problem with doing that is the company, if you have these assets on the books for much less than they are worth, it's going to make your income look higher than it really is. And you say, why? Well, because of the depreciation. So before in the past, they would shrink those down and say, okay, put the land on the books at this lower amount, put the equipment on it at this lower amount. The problem is that when you do that, you look like you're a smaller company than you really are. And therefore you look like you're more profitable than you really are, because it looks like you have fewer assets and you have fewer expenses, even though you're actually a bigger company. So that is kind of the reasoning why they allow for this gain to be booked immediately. And they say, okay, you can have the gain in the 1 year, the year that you made the gain, basically. And then everything else goes on at fair value. So you are going to be evaluated based on the true amount of assets that you have, basically. So instead of having these undervalued assets that are, making you look more profitable, you get to recognize the gain. It's all in the 1 year. There's a 1 year only deal. And then in the future, in the future, you're gonna have everything at the fair values. You're not gonna look like you're overly profitable because of the accounting method. But it is kind of strange, and especially for those of us that came up with don't ever do this, thing. Okay. Let's go on to number 6. Now, number 6 is not dissolved, and that's going to be, well, I'll show you what it ends up looking like. One of the things that a lot of times happens in mergers is a lot of times that they will switch one company stock for another. I'm going to bold this whole thing. You get messed up anyways. All right. And there are some advantages to it for both sides of the. So if you do it for cash, you hand them cash and they give you the keys to the company, right? And there's nothing wrong with doing it that way. And some mergers are done that way. A lot of times the larger mergers are done by exchanging cash. So let's say that General Motors buys, I don't know, Granger or some other company, that a lot of times what they'll do is they'll say, okay, for every 1 share of your stock, we'll give you 3 shares of General Motors stock. And so they actually aren't getting cash. Now, they can get the General Motors stock and sell it immediately if they want. There's nothing wrong with doing that. But a lot of times they're done based on shares of stock. The advantage for the company that's buying is you don't have to come up with a bunch of cash. In some of these big mergers, they'll be in the billions. So you don't have to come up with that kind of cash. You can simply issue more stock. The advantage for the sellers is that if they get a big payout in cash, that's going to trigger gains that they have to pay taxes on, and maybe they don't want to pay tax on gains. They don't want to sell the stock. But if they get when they transfer 1 share of stock to the other, then it's simply a continuation and they don't get taxed on it. So there are some advantages, you know, to both ways, but a lot of times you see like the larger mergers, they'll have, you know, they'll exchange stock. Sometimes it's stock plus cash or however they work it out. But let's see what happens with this. And we always do this at the fair value. Okay, so they issued 5,000 shares of stock, common stock, with a $5 par value to buy all of Canary Corporation's outstanding stock. Blah, blah, blah. The corporation was not dissolved after the acquisition. Okay, so let's take a look down here and see what they're looking at. So we will say, so net assets. You don't even need to do this one, but you can. 110,000. The one we're more interested in is this one, which is 120,000. Okay, now we purchased this for 5,000 shares of common stock, and par value is, I don't know, do you guys remember this from your, do you remember this from your way back when? Par value is a value stamped on stock that means that the company cannot sell that stock for less than the par value. And it's there for, and by the way, it's sometimes required by the states. There's some states that don't require it. So some states require you to have a par value. Some states sell for whatever you want. The advantages of a par value is that that's a minimum price the company can sell the stock. So for instance, if you buy the stock for $12 a share, you don't want to have the company sell that stock to somebody else for $1 a share. So it kind of puts a floor in saying, look, you can't sell it for less than $5 a share. You can sell it for more. You can sell it for $6, $10, $50, whatever, but you can't sell it for less than the par value. A lot of times it's almost a meaningless number. You know, there's some companies have 1 cent par values. So to some extent, it can be a kind of a meaningless number, but nonetheless they have it. So the par value and the fair value are usually often two completely different things. And the fair value is what the value of the stock is. So that's what we're going to use for our basis. Just like we have the, you know, the assets are on at fair value. When we value the stock, it's going to be at fair value. Okay, so what did we give up? Let's see. 5,000 shares. Okay, so we have 5,000 shares. The fair value is 27. Because he is looking to catch every down pass on a teammate's drive. He's looking to spread the floor to be a vertical run for the rim. Okay. What is that? 5,000. 27. 135,000. Okay, so we purchased it for 135,000. Now, the excess is going to be what? Anyone?
15,000.
Yep, and it'll be goodwill. And when we you'll see later what we do with it, so. So goodwill will be the 135,000. Minus 120. So this will be the goodwill amount. But we're not gonna actually put that on the books. I'm gonna show you what we're gonna put on the books. We're gonna put this on the books the same as we would normally put on it on the books for just a regular investment. Now, instead of equity, we'll put consolidations or consolidation. And we'll put it on for the 135. We're not going to put the goodwill on separately. The goodwill is included in this 135. You know, included in this 135 is that goodwill, so we're not going to put it on twice. Now, stock's kind of wacky. I really wish they wouldn't do it this way, but they do. We'll have common stock. Oops. It's an equity account. Going up. And we put common stock on at par value. So we have 5,000 shares.
Times 5 would be 25K.
Yeah. Yep. Then
Professor, would be the excess would be go to the additional paid-in capital? The one-
exactly. I'm gonna do it. Wait a minute, what did I do here? I'm gonna put the calculations for this up too. Yeah, we have an account called additional paid-in capital. The actual account would be called additional paid-in capital in excess of par value. Well, I'll write out the whole account. And usually you'll see this abbreviated just as APIC. Oops. Additional paid-in capital. And I've even seen it on financial statements just listed as APIC for companies. I'll just call it APIC. It's a little bit wordy. So you can write, you want to write out, you can, but APIC is fine. Additional paid-in capital. It's an equity account. Yep. And the additional amount is 5,000 times. I'll do it a little differently. Hold on. Use a different bracket here. 5,000 times 27 minus 5. Equals, oops, 5,000 times, what was that, 22?
Yep.
110?
Yep.
Get that to fit on one line if I just take those out. No. Hey, how come you're not going up? Hey, there we go. Okay, so. So this will be 110. And yeah, both those, yeah, 135,000 total, both sides. Okay, we're at 7 o'clock, but we only have one more problem to go. You want to just push through and get out earlier, even earlier?
Yeah, let's push through.
All right, one more.
Yes.
Come on, guys. You with me? All right, so down here. Same thing as before, with the exception of it's for $23 a share. So everything else is the same. But it's only $23 a share. Okay. My laziness principle still is intact, though. My laziness principle works everywhere. All right, so 5,000 times 23. $115,000. Okay. Well, what's the problem with this one? What do we have here? So our stock that we gave them was worth 115,000. We got $120,000 net worth of stuff. So what do we call that? The difference between those?
Again,
Gain. So the gain is 120,000 minus 115 equals 5,000. And that is a gain. Okay. Now we're going to put that gain in our journal entry. That's the only thing that's going to be different than up here. So let's copy this down. Oh, don't do the way I just did it. Hey. Okay, my being lazy principle isn't working right now. That's kind of working. Okay, now notice that this consolidation up here, this is worth 23. So this is, oops, 115. No, it's not. They're on the books, it'll be on the books at the fair value, this is on 120. Down here, this is 23 minus 5 equals 18. So this will be what, 90?
Yep, 90.
And so here's what we gave up. We gave up 115,000. We got 120,000, so we're going to have a gain of put down here. Oops. So gain on purchase.
I'm sorry to interrupt, but isn't the investment consolidation actually 115,000?
We put it on at the fair value.
Oh, I see. Okay,
Yeah,
got it.
so the
Thank
fair
you.
value, and what we gave up is also at fair value. So this
I
would be
see.
gain on purchase of 5.
So will we still put that amount 5,000 times 23 in that box there?
So yeah, the new fair value was $23. So minus 5, yeah, would be down to 18.
No, I'm talking about at the top under investment consolidation. Should we still have that there?
Oh, no.
Okay.
I get what you're saying. Yeah, no. Yeah. Thank you.
Mhm.
Yeah, these go on at fair value. That's what I should have put it on the first one, fair value. And even on this other one, you say, well, wait a minute, fair value, but these are the fair values. Actually, if you think about it, goodwill is an asset. So that would also be considered what you think of as a fair value. Sometimes they call it identifiable assets and not identified, but that doesn't mean it's not fair value. Goodwill is an unidentified asset, but it is still a fair value asset. And we will stop there. Yep. Okay, question on that thing? Okay, well, I will send out the I know I'm gonna tell you about this. The acquisitions that just did real quickly. When you get a designation like a CPA or CMA or a CI, whatever it is, you have to go to continuing education. You have to keep going back for seminars and things like that. Excuse me. Now there was these seminars and they were just terrible. I was kind of wandering around looking, it was one of these things where they had a whole bunch of different things to choose from. And the things that I chose were not very good. So I remember like going out in the hallway and I walked into one of that was going on was for mergers and acquisitions. And it was very interesting about all these people that try to make these mergers and acquisitions work. Could be a very lucrative field. They usually give 1 or 2% of whatever it is. Doesn't sound like it much, but when you're dealing with hundreds of millions of dollars, 1 or 2% of hundreds of millions of dollars is a lot of money. But just you get people putting it together and just try to getting all these different sides and all the lawyers and all that kind of stuff to work together. It's incredible how much work it takes. But anyway, so I will send out the chapter 1 exam. You get a little more than a week to do it. It's doing the 10th, so I think you have plenty of time to get in. Make sure you turn it into Blackboard though, and I think I've already said that. But yeah, so in Blackboard you can turn it in. It should be in your email in about. I'll try to get it in there like the next hour, maybe a little earlier. Any questions? Okay, well, I will see you guys in a week's time.
Thank you so much.
Thanks,
Thank
guys.
you.
Thank you. Have a good night.
Oh, I will.
Thank you.
Good night.